Hey everyone, welcome into another Monday Markets Update. I'm Austin Koenig, joined with me by Rob Pieklo. How's everyone going? Rob, how are you doing? How's the weekend?
Awesome, good weekend. Kind of ready to rock and roll with this somewhat eventful week. So I'm excited to kind of get into this with you. And sorry, I'm filling in for Sean as usual. Normally it's way more exciting. There's way more stuff happening in the markets, but it's been somewhat of a dud this last week or so.
Yeah, so last week, I was touting on the Monday Market Update. Yeah, be prepared for volatility, all this sort of stuff. Boy, was I wrong. It was very quiet, and it seems like the market just kind of came to terms with what happened in the previous weeks with all the bank crises, right?
Bank failures, and then you expected to see incredible volatility. I was right with you there. I thought for sure it was going to be a bouncy week, and then we saw the 10-year trade in a range, within 10 basis points or so, for the entire week, which is unheard of, especially lately.
Yeah, no question about it. And on top of that too, we had PC come out. It just another kind of refresh of those numbers, and nothing really too crazy to look into there. And if anything, we've kind of gotten not any drama to deal with today necessarily, other than possibly oil prices. I mean, luckily for me, I did make a right prediction. I filled up my car this weekend. Oil prices went up 6%. So obviously me and OPEC are, hand in hand in terms of our moves there, but that's something that we can add into this. But I don't think it's too significant compared to what we actually have later in the week. We have Wednesday, we have ADP job numbers. So that's kind of the first hint of what we might see in terms of the Friday BLS or non-farm payrolls number, which is kind of the headline banner job number that the Fed takes a look at. And that's coming in on Friday. Any kind of uneasiness you have about it? I mean, it's a big number for the market. Every fixed income trader in Wall Street on Friday morning is looking at that.
Yeah, I think the trend was our friend going into this. Once we've kind of had the 10-year push down, this OPEC thing today was kind of odd. It just makes it harder for the Fed to do what they want to accomplish, right? So from that standpoint, maybe there's some bias on this, potentially, causing some issues in the next month or two in terms of what that does to inflation. So, we'll see what that looks like. I think for me, the panic I have is when things are dull. It's almost like there's like energy being stored for some kind of larger move. We said that last time. We said that the last month we had this kind of like week long kind of trading range, and then boom, we got hit with a large move downward. And I'm just curious to see what happens here. I think the jobs number is going to be a big one. There's going to be a lot of volatility, and I expect a lot of mortgage people to do what we do best, which is make sure there's margin in there to protect themselves and make sure they're in a positive position for their hedges, because it's going to be a pretty volatile end of the week, especially going into the holiday.
Yeah, no question, and that also adds a little spice to it. For Friday, it's a market close. Actually, equities aren't even open on Friday, and we have the fixed income markets closing at 12 Eastern. So, um, what volatility there will, occur. Whatever occurs on Friday, it's going to be a shortened time. It's not going to be able to figure itself out in the afternoon by any means. Or get worse in the afternoon. It's really kind of a sprint to craziness, and then we'll have the weekend essentially. So luckily, whatever craziness happens in the morning, it'll kind of stop there. But next week we'll have more stuff to figure out, I guess you could say.
Yeah,
But
so once this comes out, there's going to be the usual knee-jerk reaction. We'll see some trading maneuver, and whoever's left at the desk on Friday making their trades, I'm sure it's going to move significantly. And then just mortgage companies are just going to protect themselves. So I always say, like, I can't tell you it's going to be better or worse. We can only say that Friday's pricing, in terms of a margin perspective, should have more margin in it because of the volatility. So if you really need to get something locked, probably the best idea to get it done on Thursday or waiting until after the weekend.
no question, I agree. So I think really in terms of like the banner things that we're looking at, that really covers it for the most part. We don't have any Fed meetings this month or upcoming week. Actually, the next Fed meeting we have is in early May. So really, this is kind of the big month of data. All the data we need kind of goes into that Fed meeting essentially. I don't know off the top of my head if there's a jobs numbers before the Fed meets. I believe there probably would be, but I could be wrong. So generally, there's going to be a lot of emphasis put on this data. It seems like everyone's pricing another 25 bip rate hike, for the May meeting, and that's kind of what I'm seeing. Unless something crazy happens, do you see that kind of holding true?
Yeah, I think they've not deviated from their plan, and we all get surprised when they do exactly what they say they're going to do, which is odd. But I would say we definitely start paying attention to housing and housing data and looking at that. I think it's important to see a lot of markets being really, really strong still. And this spring buying season and seeing the activity that's happening, it's something to look out for, because I think everyone had thought this was going to be a really, this downward trend in housing and affordability and these issues. But now we're starting to see prices rise again in a lot of areas. We're starting to see competitive markets, bids going, above asking again. We're seeing that in a significant portion of the markets today. It's interesting to keep an eye on that and see what that data reveals.
No question. I actually read a fairly interesting Wall Street Journal article, I think a week or so ago, and it was talking about the divide of the country, actually. And almost you can point to Austin, Texas, believe it or not. And you can look at pretty much everything east has had actually no real weakness to the market. If you look at, appreciation, there's still been kind of a little bit of resiliency. A lot of those towns also did not have the huge bump up. Now that's not including like Miami and some of South Florida. Obviously, they've had a crazy market and still continually be strong. But some a lot of the East Coast, maybe some of those cities that did not have a crazy ramp up in COVID. But the West Coast, the western half is a little bit weaker, but it's still not like dramatic drop offs. And I think that's probably going to start to strengthen a little bit, like you said, some of those competing offers, and kind of the affordability issue hasn't been as prevalent in terms of what we see in the data, and even anecdotally from like what you've said as well. There's been competing offers. I know Sean was kind of digging into that a little bit last week in terms of his own market too, in the Atlanta area. It's interesting to see, and I think it's kind of it's not as competitive as it was in the absolute worst of it during the 2021 complete sellers market. But I think it's kind of coming to a more happy medium to an extent, but still definitely not the weakest market we've ever seen. Strength still there.
Yeah, we're feeling it. We're seeing it in the market. We're seeing it from just the production from our team members. You're starting to see the activity, so you kind of see what's happening in our trend of locks, our trend of applications going in, and obviously our funded loans. So you're seeing that on a small scale from us, but you could really feel that activity and really see. It's not just sending in that pre-approval letter these days, and you have to actually do some work to try and get your buyers to be able to win a bid. Which is interesting. So that's a different market. Not used to that. There's a lot of activity this weekend here in Florida, at least. I was shocked to see how much. It's not the inventory is still pretty low, but in terms of buyers that were going out and looking at these homes, we got some feedback that there was a lot of activity in our areas here in Florida. So it's good to hear, good to see, and let's see if that continues. Even though, like I said, affordability is kind of at the brink, at the top part of what we're used to seeing.
No question. And for those that are looking at the data, like how do they see the inventory problem getting solved? I think that's the main thing, right? That everyone kind of points to, and I think it's generally very true. Inventory is the biggest issue in terms of if you're a buyer trying to look for something that doesn't have competition. There's not many places to look around. So how do you see the inventory issue resolving itself, or if it doesn't resolve itself? Kind of what data points you tell those to look at to see how inventory is going to be fluctuating?
Yeah, I mean, if you look at it now, and we always go into this, if the interest rate is low that they have, people aren't going to be selling their home and moving into the next home. But you see this like sweet spot where people start to feel somewhat comfortable if they're in the threes, and if you get that six handle or potentially the high fives, which is where we've been hovering, it isn't as much of a sticker shock as that seven or high sevens that the people were getting. So they're much more, I guess they're okay with potentially getting that type of interest rate and not being that much different than what they have right now. The inventory side, obviously, equity positions are fantastic. So people are starting to realize as debt has been growing that maybe this is an opportunity for them to cash out of their home with that sale and either downsize or get into that next home. So we're starting to see people, not just the transient folks that have to go because of a job or whatever it might be. We're starting to see people with a lot of equity put their houses on the market to be able to kind of cash in at that one standpoint, pay off their debts, and then get into that next home, granted at a little higher interest rate, but that next house might be a little bit more affordable because of it being a little bit less, or downsizing in that case. So we're starting to see that here, and obviously we need inventory, we need people to sell homes. So a smaller move. I think if you get a smaller move in rates, you're going to see a lot more activity, people being comfortable doing it, because not everybody's at 2. There's a lot of people in that, I know the 2.5 and 3, what people talk about. There's a lot of people in that 3.5 to 4% range that this isn't going to have as much of a drastic effect in their payment as you would if you were in the 2s or 2.5%.
Yeah, no question. And honestly, if you have a 2.5 or 3% rate on your mortgage, you have to tell people about it, because it's like the biggest bragging right of all time, and deservedly so. It's awesome. So, but yeah, you're right. There's not everyone's at that rate. There's people where it's going to be less of a, I would say, opportunity cost to leave, and it's a matter of time before they make those decisions. So, completely agree with you, Rob. Anything else you want to touch on? I think we covered a good amount. I know we don't want to leave it too long here, but I think we covered a lot of stuff, to look forward for this week, as well as just kind of generally the housing data that we should be looking at in weeks to come.
Yeah, I think the only thing I would talk about is just MBS activity and seeing who's buying what and where premiums are. I think it's important to focus in from a mortgage originator standpoint, looking at the note rates and just looking at the differences in those note rates based on coupon, based on MSR value. There's a lot of stuff going on that is the kind of mixed bag of how pricing works. So really, we talk about it a lot. Open up the stack. If you're an originator, take a look. Sometimes 7.375 looks good, but then you realize you can get all the way down to 6.5 or 6.25 in some instances for not much more price. So you have to look at that. The way things are pricing, it isn't this linear move of rates go up and pricing goes up with it. You're in this kind of weird position right now where everyone's still feeling out whether or not they want to pay a premium for that particular MBS or that particular Ginnie security.
No question. And the simple math here, guys, as you go lower in interest rate, the higher the MSR value becomes. It's the perfect hedge for mortgage originators, right? And that's because it kind of goes the inverse value of the premium, right? So that's where these juice pricing at the lower parts of the rate stack come into play. It's all based off of MSR. So what Rob's saying is exactly right, and I couldn't agree with you more. Open up the rate stack. There's sometimes some very valuable nuggets that you can find, and you might see someone, a competitor, put a rate that's lower than what you saw as maybe par, but take a look at what they're charging. You might be able to even beat that just in your own rate stack, essentially. You just got to open it up and take a look, and that might be the most valuable rate for everyone to kind of originate at based off the MSR value.
Yeah, for sure. Not all discount points are created equal, right? We'll say that. Right. So you can see 1 point might get you 75 basis points in rate, and then that next eighth costs another point, which doesn't make any sense. So that's just the way the market is right now. That's the way it's hard to get premium. It's hard to get consistent premium in the MBS coupons, especially the higher ones. So just open up the stack, take a look, and find value for your clients.
No question about it. Awesome. Well, Rob, I think we covered a good amount. I appreciate you hopping on today. It was great talking as always. And everyone have a great week. Let us know if you have any questions. Drop them in the comments below, and we'll get back to them when we can.
Awesome.
Have a great week, everyone.
Thanks, Austin. Thanks, guys.